Hello, and welcome to the Hammond Iles Wealth Advisors Financial Power Hour. My name is Greg Hammond, the CEO of Hammond Iles Wealth Advisors, and on behalf of our entire team, I would like to welcome you to Financial Fundamentals. Each month we take one subject matter and drill down, and so I encourage you, if you find a lot of value from our workshop today, that you look at our website at hiwealth.com. at the upcoming workshops that we'll be hosting, as well as the other recordings that we have of our financial workshops. So today we're talking about financial fundamentals. Whether you are new to investing or just relatively new or a longtime investor, today you will find some information that is applicable to you that will provide you a better insights for your financial future. So let's start with some basics. When it comes to financial basics and building a strong foundation, it's all based on being able to have freedom and peace of mind around your finances. And that all starts with an emergency savings fund. And so we encourage everyone at the very start to accumulate at least $1,000 in an emergency fund. What that does is it gives you peace of mind in that if there is an unexpected circumstance or surprise expenditure that you weren't expecting, you have the peace of mind knowing that you have money set aside to address that, whether it's a flat tire or an unexpected home repair or any other item that may pop up. It gives you that peace of mind of knowing that you don't have to worry where that money will come from. Now, once you get to that point of establishing that emergency fund for $1,000, which, by the way, should be in a bank savings account, you can look for a high yield savings account at an online bank or possibly a local credit union or a bank that may offer you a little bit higher interest rate, but it should be in a safe, secure account that's accessible to you. Once you establish that $1,000 account, then grow it to be equivalent to roughly 3 to 6 months worth of living expenses. As many people found with the start of the pandemic in 2020, that having that cushion of 3 to 6 months worth of living expenses can be extremely valuable if you see a disruption in your employment. Now, for many people, thinking that you're going to save 6 months worth of living expenses may be a very large number, and you may not want to keep that much in cash. And so some people may just have a SWAN number in mind. And by that, I mean a sleep well at night. And so that may be a set dollar amount that falls in that range. It may be $10,000, $15,000, $20,000, whatever that number might be for you. You want to achieve that and save that. Now, once you get above that amount, then you'll want to look at putting that money to work for you so that it's going to grow and outpace inflation. One of the things that many people are doing right now that we're seeing is because of concerns or uncertainty about the future, they're accumulating more cash in savings accounts than they may want or should have. Because the truth is, as we have inflation, the buying power of that money in the bank account is actually losing value. So you want to keep your money working as hard as possible for you. So anything in the savings should be in a high yield savings account, but anything above that sleep well at night or comfort level that you have should be invested and put to work for you, assuming that you are comfortable with having that invested for a year or more so that it has the ability to have long-term growth and weather through some ups and downs in the financial markets. Now, another basic is that you should use credit wisely and only spend what you have. Using a credit card, you should only use that for when you have enough in the bank account to cover what you're charging. We highly recommend against carrying any type of balance in a credit card where you're paying interest. Now, there are some forms of debt, whether it's buying a car or buying a home or a larger purchase like that, where debt can make sense in using it smartly. But as far as credit cards go, it's important to use them wisely. And so a few things I just want to mention is that for credit cards, if you are going to use one that's going to give you a benefit in doing it, whether that's cash back in your pocket or miles or points towards a travel in the future. Use those things that will give you a reward for using that credit card. Now, there are some out there that have annual fees and only pay for a credit card if the benefit that you get from that card is greater than what you're paying. So for example, there are some hotel chains that offer credit cards that you pay an annual fee, but you get one night stay at the hotel once a year for that. So you may say, well, the cost of the hotel would be more than what I'm paying in the annual fee on that credit card. So it's worthwhile to have that credit card. The other thing around credit is that if you are married and have a married couple, you want to make sure that each of you have at least one credit card in your individual name. If you are a spouse and you just get an extra card on your spouse's credit card account, that credit card does not count towards your credit history. That credit card will only count towards the primary card holder whose social security number is being used for that credit card. So it's important that you have a card in your own name to build a credit history. And that is an important reason why, as people graduate from college or even in college, should consider having a credit card, is because you want to build that credit history. I know in talking to my own daughters, they questioned, well, why should I have a credit card when I can just use my debit card and have that money come right out of my bank account? Since I already have the money in the bank account that I'm spending, why shouldn't I just eliminate the step of having to pay the credit card bill? Well, the reason is twofold. Not only gaining the cash back or the points or bonuses you may have from a credit card, but you also start to build that credit history so that when you do get to a point that you are buying a larger purchase like a car or a home, you have a track record in history of being a good steward of using that credit and paying it off on a timely basis. Now, my daughter, she still goes and doesn't wait for the credit card statement to come. She'll still go and pay off the credit card ahead of time because she just doesn't like the thought of owing money to somebody. But at least making those charges on the credit card, it provides you the opportunity to build that credit history. It also gives you kind of a safety valve. So if you do have an unexpected expenditure, you can address it and pay for it right away on the credit card, and it'll give you that roughly almost 30 days before the credit card bill comes in to have those funds ready and available to pay that expense. So use credit, but use it wisely. Now, if you do have debt, there is a strategy on paying that. And there's a couple of things that I want to point out. First is pay down the debt with the highest interest rate. So for example, if you have student loans from attending school and you have a loan for each year you were in school, you most likely have 4 loans, each with their own interest rate. Now, in addition to making sure that you make the minimum payment that's due, I would target any additional payment that you're making on that debt towards the loan that has the highest interest rate. It's the same thing if you happen to have multiple credit cards with balances on them. Make sure you make your minimum payments, but beyond that, your extra payments you want to put against the loan or the credit card with the highest interest rate. Now, a second strategy on paying down debt is what we call the snowball effect, that you want to gain some momentum. So also another strategy is if you have a loan or a credit card with a relatively small balance, tackle that first so that you get that sense of accomplishment in crossing that off. So use the snowball effect as well as focus on those loans or debt that you have with the highest interest rate, and that will give you a lot of benefit going forward. Now, one of the things as you start to build on your financial foundation is to look at budgeting. And we like to recommend the 50-30-20 rule, basically looking at your needs, wants, and wishes. And that 50% of your take-home income should be focused on your needs, those things that you need to have. It's like your rent or mortgage payment, your utilities, groceries, transportation, insurance, those things that are must-haves. And when it comes to your housing, whether that's rent or mortgage payments, ideally that should be no more than 30% of your take-home pay. So keep that in mind when you're also looking at that as part of your 50%. The next 30% are for those wants, those things that you have for your lifestyle, your clothes, eating out, the activities that you do, charitable donations, things like that, that are part of your lifestyle, but not absolutely necessary. And so those things, if you have more one month or another, you can adjust based on your budget. And then ideally, you want to save 20% towards paying down debt and saving for the future. Now, keep in mind, if you have an employer retirement account, like a 401k or a 403b, that counts towards your 20%. So if you're putting 5 or 6% of your salary away, then that counts towards your 20%. But ideally, you'd want to live within 80% of your take-home pay. And that's the best way to build for your financial future. Now, one of the things I alluded to earlier when we were talking about building your emergency savings account is about holding too much cash. And the reason we bring this up is that holding cash, especially right now where we've seen inflation increase, is that it loses value over time. And here are just 3 examples looking over a basically a 30-year period, in that a single family home that may have cost $97,000 back in 1991 cost $376,000 on average in 2019. A loaf of bread went from 72 cents up to $1.26. Now that doesn't sound like that much, but that's a 50% increase in just a short period of time. And a college education went from roughly around $5,500 per year to over $26,000 per year. And so if you're just having money in the bank, that money is holding its value, but it's losing its buying power over time. So keep what you need for your emergency savings safe and secure, but beyond that, make sure that your money is working hard for you. And the best way to do that is to invest it in a portfolio to gain market returns to grow and outpace inflation. Now, another thing is you're starting to look in retirement, whether that is for you in a very young age, looking ahead to retirement, or if you may be approaching retirement yourself, is to also be aware of kind of using inflation to calculate how much do you need to save for your retirement. And that comes back to not only looking at inflation, but also what we call the 4% rule. So let me use as an example, if you are currently living on $50,000 per year, if we have a 2% inflation rate and you're 10 years away from retirement, you will need to plan to have $61,000 as an income need in 10 years from now. In 20 years, that would be $74,000, and 35 years, $100,000. And if certainly the inflation rate is 3-4% or even higher, those income amount needed to meet your living expenses goes up even higher. Now, the other aspect, kind of working backwards as to, well, how much do I need to save for retirement? You can take a look at using the 4% rule. So for example, if I have $1 million, it's said that roughly taking 4% of that portfolio out per year, you'll be able to maintain the level of your portfolio as well as have it grow a little bit above and beyond that to help hedge against future inflation. So $1 million would provide you $40,000. So to generate $50,000, you need to have $1.2 million. And certainly to get $100,000, like we're talking about the 2% level on this slide, you would need to have $5 million in retirement savings by the time you reach retirement in 35 years from now. So that can provide you some guidelines on just taking a look at the calculation of how do you get there from here. And if you need assistance, that's where a financial coach from Hammond Iles can assist you with that retirement calculation. But don't feel overwhelmed by that, because if you're starting early or you have that time between now and retirement, you have one of the most powerful things on your side. And that is the power of compounding. So let me ask you this question. If I were to offer you $3 million in a lump sum in a check today, or give you a magic penny that would double in value every day for a month, and I'm talking about a month like March for 31 days, which would you choose? Now, most of you, I would guess, would probably think that that $3 million lump sum is a pretty good deal. But let me show you the power of compounding. So if we start with our magic penny on day one, we then see it double to 2 cents. And by day 2, it's 4 cents. And day 3, it's 8 cents. And by day 10, we're a third of the way through the month, and we've gotten up to $5.12. Woohoo! Right? You're kind of wondering, did I make the right choice? Well, by day 20, well, it's gone up significantly. We're now up over $5,200, but it's still a long way away from $3 million. But the compounding starts to really compound, as we see by day 25, we're now up over $167,000. By day 29, we're now just shy of the $3 million at $2.68 million. By day 31, though, by doubling and doubling again, we end up with $10.7 million, well above the $3 million that we started with. But it wasn't until that very end stretch where we've built on those 31 days that we get that substantial growth. And so the moral of the story and what you should take away from this power of compounding is that you should start early and save often. The more time you have between now and retirement, the better for you and your financial future. Now, I'd like to just show you this through the example of 3 friends. So we have Aiden here. He graduates from college and he starts right away. And at 25, for the next 10 years, he starts socking away $400 per month, or roughly $100 a week. That is investing. And in a diversified portfolio, he is averaging an 8% annualized return. So putting $400 a month in, he does that for 10 years. So his total investment is $48,000 that he has saved. And at 35, for whatever reason, he decides to stop. But he allows it to grow for the next 30 years until he retires at age 65. And what he ends up is almost to $730,000, even though all he put in was $48,000 at the very beginning, because he started early and he allowed that money to grow and compound over that time frame until he turned age 65. Now, his friend James, he wasn't quite as astute to start right after college, but he did start at age 35, and he continued saving all the way out to age 65. And he did the same $400 per month. And for him, he contributed a total of $144,000 over that time frame. And to keep apples to apples, it earned the same 8%. But what we see is a dramatically different outcome. For him, at age 65, he ended up with only $567,000, even though he contributed a significantly more into the account over time. He paid over $100,000 more into the account, but yet ended up with less at age 65. And it shows the power of saving early and allowing those funds to grow and compound. Now, then the third friend is Sarah. And guys, I hate to break it to you, but a lot of times women are better investors. They stay more disciplined to their investment portfolio and they're just better savers. So find a good woman to emulate. And in this case, we're going to talk about Sarah. Now, she, like Aiden, started at age 25 and contributed $400 per month, but she contributed all the way through to age 65. So she didn't stop at 35 like Aiden, and she didn't start late like her other friend. She started and went all the way through. And so for her, saving that $400 a month, $100 a week, growing at 8%, it grew to almost $1.3 million. So when you say, well, I don't know if I can reach $1 million or become a millionaire, the truth is you just need to get started. And this is making the assumption that she never increased the amount she was saving. So even as her income went up over the years, she just saved $400 per month, and that was it. That doesn't include any matching from an employer or anything else, just saving on her own. She was able to grow her investment portfolio to just under $1.3 million. So ideally, you want to save early and save often. And just like the Chinese proverb talks about when is the best time to plant a tree, it was 30 years ago. Ideally, you'd like to plant that tree so that it's nice and mature today to provide shade. But when is the second best time to plant a tree? It's today. So no matter if you're saving or not saving, the best time to start, if you're not already saving, is today. Now, that's why financial independence is your choice on choosing to save for that future. And here are some strategies to help you build wealth and build that financial foundation for your future. The first is when you are budgeting to save for your future, pay yourself first. Ideally, that would be automating it. So sign up for your employer retirement plan. So it just comes out of your paycheck without you thinking. And if you're saving above and beyond that, set up a systematic investment so that it comes right out of your checking account without you even paying attention, whether that's going out to an investment account, or even if it's starting to build that emergency fund where you just have money coming out of your checking and going into a savings account on a monthly basis without you thinking. Pay yourself first. Don't allow yourself to wait until the end of the month to see what's left over. And then, as I mentioned, take advantage of your employer retirement accounts. You want to always contribute to get the maximum of the match. So if your employer is going to match up to 5% of your income, for heaven's sake, contribute 5%. Make sure you're getting that free money from your employer. Even if you get hardly anything on the return of your investment, if you're getting 100% back just in the employer match, you'll be well ahead of the game. And if you're eligible, I highly recommend contribute to a Roth IRA. And I'll go into the benefits of a Roth IRA compared to a traditional IRA and your employer retirement accounts in just a minute. Now, also, as you start to contribute to an employer retirement account, as you get an annual raise, increase your contributions. So for example, let's say that you're contributing 5% to your employer retirement account. Well, if you get a 2% raise or a 3% raise, take 1 or 2% of that raise and increase your contribution to your retirement plan. You'll never miss it because you weren't receiving it to begin with. And you're still going to get a little bit of a bump up in your paycheck because you're not putting 100% of the raise into your employer retirement account. So get in the process of bumping up your employer retirement account contribution at least 1% when you get a raise. Now, the other thing to think about as you're looking at those lifestyle expenses, that 30% for those wants in life, is to think about what are you sacrificing in the future for something today? And this is one of the things that Warren Buffett, one of the richest gentlemen in the world, thought about when he was growing up, is he always thought about the future value of what he was spending today. And one of the ways to think about that is thinking about the rule of 72. And what the rule of 72 says is you take the average return of your investments and you divide 72 by it, and it will tell you how long it will take for your money to double potentially. So for example, in our example of our 3 friends where they were earning an average of 8% per year, if we divide that into 72, it means that their investment should double every 9 years. So if you have 27 years until retirement, you should see your money double potentially 3 times. So if you go to spend $100 on something today, think about it, that in 9 years, that will be worth potentially $200. Another 9 years, that will be worth $400. And then by the third 9 years, by 27 years, that'll be worth $800. So the question then becomes, is this $100 expenditure today worth $800 that I would have in my retirement? If certainly you get the enjoyment and happiness out of that expenditure today, by all means, don't live, sheltered and restrain your enjoyment today. But at the same time, don't live just for today. Make sure that you're planning for the future. So we talked a little bit about the 2 different types of accounts that you could be investing in or saving for your financial future. One is your employer retirement account, and that may be a 401k or a 403b, or if you work for a municipality, it may be a 457 plan, any of those numbered plans based on the Internal Revenue Code. Or it may be a traditional IRA or a simple IRA that you're contributing to. When you contribute out of your paycheck or by making a contribution to an IRA, those contributions are tax deductible. The amount is taken out of your paycheck before taxes are calculated, or you get a tax deduction on your tax return for that contribution put into the IRA. Now, with retirement accounts, you get the benefit of what we call tax deferral. And then as those investments earn money, whether that's paid through dividends and interest, or whether it grows in appreciation, all of that growth in income grows tax deferred. You don't pay tax on it while it's inside your account. However, eventually, when you start to take money out of that account, all of those distributions will be taxed as income at that time, not only what you originally put in, but all of the growth in that account up until the time that you take it out. So if you take $10,000 out, it's just like if you had a part-time job and earned $10,000, it's taxed as ordinary income on top of what you are already receiving as income. Now, one of the key incentives that Congress put in place in the Internal Revenue Code to encourage people when they do put money into a retirement account that it is for retirement is that there is typically a penalty if you decide to take money out before the age of 59 and a half. So if you took money out at age 50, for example, not only would you pay income tax on it, but it would be subject to a 10% early withdrawal penalty. Now, there are some exceptions to that rule, but for the lion's share, as a general rule of thumb, anything you put in a retirement account needs to stay in until 59 and a half. Now, many of these things and restrictions does not, however, apply to a Roth IRA. So let's talk about a Roth IRA and why I recommend that everybody eligible should have a Roth IRA. Well, first of all, the contributions that go into a Roth IRA are not tax deductible. So if I put $5,000 into a Roth IRA, I get no tax benefit in the year that I do that. There's no tax deduction on my taxes, and the money that I'm putting in is after tax. And the same holds true if you have the option of a Roth IRA version of your 401k. The money, rather than coming out of your paycheck before taxes, actually comes out of your paycheck after taxes. So the money going into a Roth IRA or 401k is after tax money. Now, just like the employer account or a traditional IRA, that money grows tax deferred. You're not going to pay any tax on the dividends, interest, and the growth and appreciation of those investments during the time that it's inside the account. However, one of the key differences is that distributions come out tax-free after the age of 59 and a half. And that's not only what you put into the account, but all of the growth and dividends and interest for the Roth IRA. Now, one little caveat or a little asterisk next to that is that there is a special provision for Roth IRAs. Because the money that you put into the Roth IRA went in after taxes, you have the ability to take that money back out at any age without any taxes or penalties. So if I put $5,000 in at the age of 25 and I have this emergency that I need that money back out at 27 or any age, I can take that $5,000 back out. So that is a great way to save for retirement, knowing that if there is a worst case scenario and you need those contributions back out, you have the ability to take them out. So we highly recommend anytime that you are eligible to a Roth IRA, we recommend making that contribution. And keep in mind that you have up until April 15th of the year after a contribution year to make your contribution. So for example, you have up until April 15th of 2022 to make your contribution for 2021. So if you are watching this and have not made a contribution yet for the previous year, and it's within that window of opportunity before you file your tax return, definitely take a look at making that contribution for last year. So you put the money in an investment account, you want to start saving for retirement in either in the retirement accounts, or if you've maxed out on your contributions and you're not eligible for a Roth IRA, then you want to start investing in an investment account outside of that to keep the money growing and outpacing inflation. So how do you invest it? So I'd like to take just a little bit of time to talk to you about investment basics. And as an example, I'd like to use Kelsey and Lindsay's Luscious Lemonade. These are my two daughters, and this is quite some time ago when they were younger. They had a lemonade stand on our front yard, and they sold luscious lemonade. Now, if they wanted to create this as a company and grow the company to have a second lemonade stand or expand their advertising for their lemonade stand, how would they go about raising money to grow the business? Well, the way that businesses do that is one of two ways primarily. The first is that they could issue stock. Now, stock is part ownership. So if we have 100 shares of stock for the Luscious Lemonade stand, and you bought one share, you would own 1% of the company. By doing so, that gives you a couple of rights. One is that as the company grows, the owners of the company, Kelsey and Lindsay, they could decide to pay out a dividend. So part of those earnings, they may pay back to shareholders as a dividend. The other, though, if they take that money and reinvest it in the business, you would benefit as a shareholder because the value of that company stock would grow with the size of the company and how it becomes bigger and grows in revenue and has more profit. then the value of that stock grows with it. Now, also on the backside of that is you also have the risk, and that if a company goes out of business, the stock could go to zero. But stock ownership is one way for you to invest in the financial markets. And certainly having a diversified portfolio helps mitigate that risk of owning individual stocks. Now, the other way a company can raise money to grow their business is through bonds. And a bond is basically an IOU. So for example, the Luscious Lemonade Company may decide, well, we would like to sell you a bond for $10,000, and we're going to have this be a 10-year bond. So during those 10 years, we will pay you 5% interest. So each year you'll get 5% or $500 on your $10,000. And at the end of the 10 years, we'll pay that $10,000 back to you. Now, because a bond has a length of time where it matures, the 10 years in this example, and because the company is obligated, if financial able, to pay that money back to you, the value of bonds tends to be a lot more stable than a stock, because you have that somewhat of a promise from the company to pay that money back at the end of the term. Now, certainly a company could go out of business and default on their bonds, but then again, this is the importance of diversification and not owning just individual company bonds. Now, whether it comes to stocks or bonds, there is a trade-off between risk and return. And that a company like the Luscious Lemonade stand, because there's a lot of risk there. Kelsey and Lindsay may lose interest in the lemonade. A neighbor may open up a stand just down the street. There's a lot of risk in lemonade stands. And so as a result of that, you would expect to have a higher rate of return on the stock investments because of the higher risk. And for the bonds, they would need to pay a higher interest rate to you as a bondholder than a company like Apple or Walt Disney or Amazon, a larger company that is more stable. And it's one of the interesting things that when many people look to invest in the stock market, they look to large companies. But yet, using this risk return calculation, larger companies that are more stable should get a lower return over time. And it's one of the reasons why when we look at the stock investments that are available to you, small size companies, because there is more risk, should provide a higher rate of return over time. And so all portfolios should be diversified and include small size companies which outperform large size companies over time. But yet many investors don't invest in small size companies, and you may not even know or be aware of what you're invested in. And if that's the case, Hammond Iles offers a portfolio MRI where we'll actually analyze your portfolio and be able to tell you exactly how you're invested in so that you can make better decisions for your financial future. Now, beyond owning individual stocks or individual bonds, there are a couple other areas and ways that you can invest. One of those is mutual funds, and the other is exchange traded funds. And both of these are a way of basically buying a basket or a group of stocks or bonds or a combination of the two in one investment. With a mutual fund, it can be either actively managed, where there is a fund manager or managers that are buying and selling stocks or bonds based on their outlook for that area of the market or for their mutual fund. Or you can have what's called a passive investment, which is like an index fund, which just follows a market index, like for example, the Standard & Poor 500 index. That index follows the 500 largest US companies and is followed by the Standard & Poor. And so your index fund will follow and invest in those same 500 companies. Now, an exchange traded fund, for the most part, are passive investments, just like an index fund that follow a market index. There are some companies that are starting to roll out actively managed exchange traded funds, but it is a way of maintaining a allocation on a basket of stocks. And because it holds the same stocks on an ongoing basis, there's less transactions in the portfolio, and so the costs are lower. Now, one other difference between mutual funds and exchange-traded funds is that an exchange-traded fund, like a stock, trades throughout the day. As long as the stock market is open, you can buy and sell shares at any point in time. A mutual fund, however, will only trade at the end of the day. So if you put in order to sell your mutual fund at 10 o'clock in the morning or 2 o'clock in the afternoon, you're going to get the same price. It's going to be priced at 4 o'clock in the afternoon when the stock market closes. So those are a couple of ways of diversifying and owning a broader array of investments rather than owning individual stocks and bonds. Now, one of the other things I want to point out on this list is you will not see on here cryptocurrencies, you'll not see gold or any other natural resources or commodities. And there's a reason why we left them off the list, is that we do not believe they belong in your investment portfolio. Things like precious resources like gold, silver, or things like cryptocurrency or non-fungible tokens, they have an extremely high level of risk. And things like cryptocurrency have no expected rate of return. It is just a digital investment that is based on supply and demand. A cryptocurrency does not produce any goods, does not provide any services. It's all based on what someone else may be willing to pay for it. And so because of that, you can gamble on it, speculate on it, but it is not an investment, and we do not recommend it for your long-term future. So when it comes to investing, how do we go about doing that? And there are 3 simple rules to creating a portfolio. The first is that you should own equities or own stocks. No matter your age, we feel that stock should be part of your portfolio in some form or fashion. We're not recommending that everybody be 100% in stock, but there should be a portion of your portfolio based on the level of risk that you're comfortable with that is invested in the stock market. And it all goes back to making sure that you're going to grow and outpace inflation. All too often, we see people become too conservative with their investment portfolio, and they're not able to keep up with inflation. So you want to make sure that you own stock as part of your portfolio. And then for the stock and bonds that you do own, you want to make sure that you're diversified, not only in large and small size companies, but also globally around the world. The portfolios that we use here at Hammond Iles are invested in over 23,000 stocks and bonds across 80 different countries around the world. So you want to be globally diversified. And then the third rule, and one that is really hard to implement and really hard to do, is to systematically rebalance. So let's say, for example, that your portfolio is 50% stock and 50% bonds, a balanced portfolio. Now, if the stock market is doing really well, that 50% in stock grows to 55, 60%, 65% of your account. And you're like, great, it's growing. Why would I want to sell? Well, the reason is by allowing that to grow without rebalancing, by trimming that stock position back, you're actually taking on more and more risk. Where you started with 50% in bonds and 50% stock, you're now having more and more invested in stock, and you have more risk. So rebalancing is a way of maintaining the level of risk you want to have in your portfolio. And we do it on a systematic basis. It's not trying to time the market. We're not trying to pick the lows and pick the highs. It's done systematically, and for our firm, every 90 days. So every 90 days, we're looking at the allocation in your investment account. How does that compare to the target that we want to have for the level of risk you want to have? And if it's more than 5% away from that, we'll rebalance it back. So you want to own equities, diversify globally, and then systematically rebalance. Now, one other thing that I want to bring to mind and share with you today is a way of thinking about, well, how should I come up with my portfolio and coming up with the level of risk? And one of the ways that I like to describe a portfolio is through a sailboat. Now, with a sailboat, there are two primary components beyond the boat itself that make up the ability for that boat to go fast and to go to the destination that it wants to go to, as well as to maintain some stability in that boat. So the way that I compare that to a portfolio is think of the sails that catch the wind, that propel you forward as your stock or equity in the portfolio. And then the bottom keel that sticks out to provide support and stability, that's your fixed income or bonds on the bottom. Now, if you want your sailboat to just fly through the water, you could create a very small keel and make a huge sail, catch all the wind you want. But by doing that, it's going to have a tendency to have a lot of volatility and swinging from one side to the other based on the wind and the prevailing direction it's coming from. Whereas if we want to have more safety and security in our portfolio, we may increase the size of our keel or the amount invested in bonds or fixed income. Now, what that will do is we'll have a smaller sail, we'll still go forward, but it'll be at a much slower pace and it'll have less rocking from side to side. So think of your portfolio as a sailboat in trying to determine how fast you need to go and how much rocking are you able to withstand. So now we know kind of some of the general rules for investing. We know a way to think about the portfolio. What are some investing pitfalls? What are the things that you want to avoid? Well, the first kind of goes back to inflation, but also longevity risk. Don't be too conservative. There are a lot of financial media out there that talk about the fact that when you hit retirement, it's time to downshift your risk in your portfolio. Well, I caution you against that, because when we take a look at individuals, males have a 41% opportunity to grow to age 85, women 53%, and if you're a married couple, a 72% likelihood that one of you will live to age 85. And even looking out to age 90 for a married couple, 45%, almost half of a chance that one of you will grow to age 90. So you have at 65, you have basically 20 to 25 years of retirement to plan for. So don't become too conservative by allowing your portfolio to trail inflation over that time frame. Now, another pitfall is allowing our humanness, our emotions, our instincts, our perceptions to get in the way of our financial decisions. Many people, the way that investing works is they make an investment, got a good tip, heard something good, they like that company, and they invest and they are initially encouraged. They see the value start to go up. They become a little bit more confident. The market's going up. They get thrilled when they start seeing that balance, and they do a little happy dance of being euphoric when it's doubled or gone up dramatically. But then they get surprised. And actually, many times investors wait until that euphoric dancing part to start investing, to even begin with investing. That certainly is what happened in the tech bubble in the late 90s, that people got in when they felt comfortable and confident in the market. But then along comes a surprise, whether it's a global political event, whether it's a change in the political landscape in Washington, there's a surprise. We become nervous and the market comes down. We become a little worried. Now the market may kind of dip back up, but then it drops again, and now we're really concerned. We panic, and we allow that fear and emotion to cause us to sell our investments. And so what we have a habit to do as humans is we tend to follow the herd, and coming in when everything feels good and comfortable at the top of the market. And then as things get rough and the market goes down, we have a tendency to pull back and get out. And that has a detrimental impact on your financial future. What we see is really the best way to invest would be the opposite. And studies have proven this by looking at what these investors, either following the herd or going against the herd, actually had in returns. So if we look at 3-year returns based on kind of quarterly or every 3-month flows into the stock market or out of the stock market, what we find is that following the herd, basically buying when other people are buying, which tends to be where the market is up or people feel confident. After that point, the following 3 years, they average a rate of return of 5.5%. Now, going against the herd, so when everybody's panicked and selling out, you're buying in, those individual investors earned an average of 14.8% per return because they're buying when the market is low. But again, this is very difficult to do because the financial media know that we're human, that we have this part of our brain that goes back to when we were just trying to survive and saw a rustle in the weeds over there and wondered if it was a saber-toothed tiger. We are always on the lookout for concerns for our survival. And because of that, we pay more attention to negative news and negative headlines than we do of positive news. Studies have shown that people will click on a negative headline 60% more than a positive. And it's one of the reasons why the nightly news will always lead with a negative headline rather than a positive, because they know it will capture your attention, that part of your brain of being human, tap into your emotion and your fear and keep your attention. And it's one of the reasons why if you have the news on for an extended period of time, you may start to feel some anxiety and fear. And so my coaching for you is turn it off. Turn off the media. It's certainly important to stay informed and know what's going on in the world, but don't let all that run in the background all day or all night, listening to it nonstop. It's just a negative content coming into your brain over and over again on gloom and doom, creating more fear and concern for you. Turn it off. Stay connected to a financial coach like Hammond Iles that we will stand by your side during the turmoil of the financial markets to coach you through dealing with those emotions and instincts that you're dealing with. The other importance is not to panic, is to stay invested. And here is an example as to why that is so important. If you invested $100,000 at the beginning of 2001 and just let it grow, investing in the Standard & Poor's 500 index over that 20-year time frame, between 2001 and 2020, that would have grown to just under $425,000. It would have more than quadrupled over that 20-year time frame. Now, the amazing thing is in that 20-year time frame, if you missed just the 5 best days in the financial market out of 5,000, you would have lost 37% of your return. Your 100,000 would not have grown to 425,000. It would have only grown to $268,000. 37%, more than a third less, just because you missed 5 days. And the amazing thing is we look at this chart, if we missed more of those days, just missing 25 days out of 5,000, you would have actually lost money over 20 years. You put $100,000 in, 20 years later, you pull money out and you have less than you started with, just because you missed 25 days. You were invested the entire 20-year time frame except for just that 1 month or those 25 best performing days. And that is why it is so important to be invested and stay invested. So how can Hammond Iles help you? We've talked about the financial fundamentals, and meeting with a financial coach, we can provide you some guidance on getting that financial foundation established for you. We offer a complimentary 15-minute conversation at any time. If you'd like to just give us a call with some questions or would like some input on an issue that is weighing on you. But also we help our clients diversify across 21 different asset classes. We also set realistic expectations for performance. Many times people are out there saying, well, we want to outperform the market. Studies have shown that 93% of actively managed mutual funds underperform the stock market over time. And so it's important that we're not trying to outperform the market. We just want to capture the true market returns over time. And we want to do that at the level of risk that you're comfortable. To reach your goals, you may not need to get a 12, 13, or 14% annualized return. Getting an 8 or 9 or 10 or 12% return may be sufficient for your needs, or maybe even less. So allow us to do the calculation of what you may need in retirement so that we can determine what level of return will accomplish that goal and what level of risk are you comfortable with. We continue to communicate often through these educational workshops as well as town hall meetings, and are able to coach you through those turmoil points of the market when we have that fear and uncertainty. We also believe that an educated investor is a successful investor. And it's one of the reasons why we put on these financial power hours to educate you on the factors that could affect your financial future. And we encourage you to think long-term, tune out the noise, turn off the media, and avoid those emotional reactions. And we also, on your behalf, monitor your portfolio and systematically rebalance, especially when it is so hard to do. We also talk about building your legacy, whether that is building a legacy for your loved ones, your family members that you care about, or whether it's for an organization or cause in your community that you'd like to impact. We help you become aware of your gifting options, help you more efficiently gift to charity, as well as pass on pass on assets to your heirs in the most tax efficient way, as well as planning your estate. Now, certainly, ideally, we want to do more giving while you're living, but also how do you make sure that your family members or the heirs to your investments are prepared to receive those investments? And that's where we work with families across 3 generations to make sure that families are working together so that everybody is successful. Now, a couple little side tips here for investments and creating a legacy for a charitable organization that you care about is think about giving appreciated investments rather than writing a check or sending cash. Many times we get that ask to just scan that QR code, send us a text message, send us a check, and we just make a donation. When you have an investment account and you have investments that have gone up in value, you're better off giving those investments to the charitable organization. You not only get the tax deduction potentially for the value of the investments that you give, but you avoid the capital gains tax that you would normally pay if you were to sell that investment for yourself. So think about appreciated investments. And for those of you that may be over the age of 70 and a half, think about a qualified charitable distribution, a QCD. You have the ability to give up to $100,000 per year from your IRA or retirement account to a charity. As I talked about earlier, anything that comes out of a retirement account is taxable to you. By using a QCD or a qualified charitable distribution, it goes straight to the charity and it's not taxable to you. And if you're over the age of 72, where you have a required minimum distribution, that age where Uncle Sam gets tired of waiting for his taxes and says that you have to take a minimum out every year, whether you want to or not, by making a qualified charitable distribution, not only do you make an impact to that organization or cause you care about, but it qualifies for your required minimum distribution. So you get two birds with one stone. So if you have any thoughts or would like some assistance on making a greater impact to your family, the people, organizations, and causes that you care about, we'd be happy to talk to you about building your legacy and making an impact during your lifetime. So I encourage you, if you have any questions from today's presentation, please send us an email at hello@hiwealth.com, or you can give us a call at 800-416-1655 with your questions for that complimentary conversation, or to just schedule a time to meet with one of our financial coaches. And we encourage you to stay tuned for our other financial power hours. And you can find a listing of all those upcoming events that are held live on Zoom on the first Wednesday of every month on hiwealth.com, or you'll find recordings on our website as well. So if you've enjoyed this workshop, go to hiwealth.com and take a look at the other workshops that we offer. And I look forward to hopefully seeing you at one of our future events. On behalf of our entire team, thank you for spending your time with us. Best wishes to you and your financial future. May you live a life of purpose that provides you freedom and fulfillment.